Our next speaker, Dr. Adrian Cronje, is Chief Executive Officer and Chief Investment Officer of Balentine, the Atlanta-based wealth management firm serving entrepreneurs and business owners. A Cambridge-educated economist, Adrian is a 10-year member of Vistage and frequently requests a Vistage speaker across the country. Adrian enjoys talking with Vistage groups about how they can positively affect their businesses using the messages that capital markets send about the future economic markets. Adrian and his business partner, Robert Balentine, who also has presented at this summit many times, are publishing a book that's going to be out later this year. Is that correct?
Yes, second quarter.
Called First Generation Wealth: Enduring Strategies for a Meaningful and Lasting Legacy. This book will address the unique journey on which an entrepreneur embarks when transitioning their business. Adrian is an active member in the community as a trustee and chair of the investment committee of Agnes Scott College, and as a member of the Rotary Club of Atlanta, YPO, and TIE Atlanta. He was named TIE Top Entrepreneur in 2018, and he was Atlanta Business Chronicle 40 Under 40. What was it, a year or two ago?
Long time ago. Thank you for calling that out.
And over the next 20 minutes, Adrian will provide insight into how to see through this political noise. This is going to be interesting of this election year in order to focus on what truly matters for your business. Welcome, Adrian.
Thank you, Patricia. Good morning, everybody. Oh, man. If you, like me, and this poor guy, are still experiencing a hangover from 2016, I know what you feel like. That, after all, was the most contentious, divisive election cycle in modern times, especially in the current environment where the noise seems so deafening and extreme, and policy is made and announced by tweet by the minute. I know what it feels like not just to sit as a member of an investment team trying to stay in control of your emotions, but also as a business owner, trying to stay grounded in what the data tells you. And by the way, those were just some of the headlines over the last 3 months relating to trade and the Federal Reserve. It does not include the mini panic that has erupted with a very serious coronavirus last week emanating from China. So there is no room for facts when our minds are occupied by fear, said Hans Rosling. Who in the world is Hans Rosling, I hear you ask? Well, he was a Swedish physicist, and I encourage you all to Google the words Hans Rosling, factfulness. It is one of the best TED Talks I have ever seen. And the message that Dr. Rosling has for all of us as business owners is stay in control of your emotions. Try to let the data tell you what reality is, no matter how uncomfortable that may be. So in the spirit of Dr. Rosling, let's examine 3 important facts about the current environment. Fact 1, we are now in month 128 of the current expansion that began in the summer of 2009. That is almost twice as long as the average period at which our economy grows since the Second World War. That horizontal line at 60 months says that if the data are any guide, you ought to expect a recession or a downturn twice a decade. 128. That's good news. We have now eclipsed the decade of the 60s on the left, the 80s in the middle, and the 1990s as enjoying the longest period of expansion without uninterrupted downturn or growth than we have ever experienced. And the most important thing that I encourage you all to think about is what was common to underpinning such long periods of expansion in the past and whether it's in existence today. And if you think back to the 60s and 80s and 90s, and you'll probably hear Dennis talk a lot about that this afternoon, is high rates of productivity growth. That is the engine that allows the economy to grow indefinitely without running into capacity constraints, causing inflation to rise, interest rates to rise, and a downturn to ensue. And so I urge you all, as you watch policy by tweet, think about what the impact may or may not be on productivity growth. There are several candidates on the horizon for where this productivity growth that for the first 7 years of this expansion was missing may come from. Washington, D.C. is talking about a bipartisan infrastructure bill. I hear a snort whenever I mention Washington, D.C. You know, it's the triumph of hope over experience, right? The second source, which was the topic of my CEO Summit speech 2 years ago, was directly aimed at you in the C-suite. And that was the Tax Cuts and Jobs Act, where an explicit aim was to encourage you all to take more risk, to invest in the future, to upgrade technology. What Dennis has done a lot of research on, I encourage you all to think about, are some of the game-changing technologies that are on the horizon. Alternative data and artificial intelligence. How is that going to disrupt your industry? Automation, similarly. The blockchain protocol. 3 candidates that may cause a rise in productivity growth that will allow the current expansion to continue. Fact 2, Dr. Rosling will tell you, is that this is the strongest labor market that we've enjoyed in half a century. The unemployment rate is down to 3.5%. And in light blue, you'll see average hourly earnings actually started to tick up prior to the last election, but has been on a steady increase since then. I have a slide in a minute or two that talks about the strength of the consumer. Think about how that underpins consumer confidence. An important takeaway from this slide is wage growth is trending up, but it's nowhere near the level of 3.5% to 4%, where the Federal Reserve typically says, hang on a minute, we're growing too quickly and inflation may percolate. So a strong labor market with plenty of room to continue. Fact number 3, and this is the conundrum of our times, is the level of interest rates. So I've traced here in gray the last 2 recessions that we've experienced, one in the early 2000s, and of course the great financial crisis and recession that we experienced at the end of the previous decade. Take a look at this chart. In dark blue, it's the 10-year Treasury bond rate. Today, the 10-year Treasury bond rate is under 2%, significantly lower than where it was on the onset of prior recessions. This is a profoundly important point because the reason why long-term interest rates have fallen is inflation traced in light blue, and I'm using the yardstick that the Federal Reserve monitors, the Personal Consumption Expenditure Deflator. Ask Dennis what that means, right? Take a look at how anemic inflation has been. The real rate of interest, so the 10-year Treasury rate minus inflation, today is just a shade above 0. Think about that. The cost of capital for all of us as we think about growing our businesses has been remarkably low. This worries the Federal Reserve because where do we go next in the next downturn? Are we going to resort to the desperate tactics that Europe and Japan have resorted to, where they have turned the world upside down with negative interest rates? Has that helped their economies stimulate? So another question for you all to ask Dennis this afternoon is where next? But the fact remains that against the backdrop of a growing economy where productivity growth may be unleashed, a strong labor market, interest rates and inflation have remained remarkably low. Unfortunately, we cannot put the politicians in a box and compartmentalize them, as much as we sometimes would like to, sir. But people forget the causality. Everybody remember the Ragin' Cajun James Carville in the early 90s? President-elect Clinton hired him, and he made this point, which is still true today. It's the economy, stupid. Take a look at this data. Over the last 100 years, if you want to handicap the outcome of November, take a look at how a recession 2 years prior to an election have killed re-election chances. George H.W. Bush, Jimmy Carter, Gerald Ford, Herbert Hoover, William Howard Taft. Only Silent Cal Coolidge was managed to be re-elected way back in 1924. But remember, he had only served as president for 2 years. And Warren G. Harding had a scandal-ridden administration, and the economy was mired in a recession as a result of the end of the First World War. But what people also forget about the roaring 20s is the impact that the automobile and electricity had in a very sharp recovery. And so Silent Kel was actually able to buck the trend. But if I were a betting man today, given the facts that we have had with regard to the economic health of the current environment, no wonder President Trump is sitting in the middle with everybody else looking in, looking quite smug and pleased with his chances. I saw an interesting chart yesterday to make this point, and that chart correlates the daily movements in President Trump's chances of re-election on Intrade and the stock market. It's like a 97% correlation. As the market starts to digest who the leading candidate on the other end is likely to be, and on the Intrade markets, it seems that Senator Sanders is making a surge, those odds are directly correlated with the bond market. And so it is interesting to watch markets begin to grapple with what a change in administration may be for pro-growth policies. Perhaps there's a chance for Michael Bloomberg to run straight down the middle with his impressive ability to manage both government and businesses. President Trump is clearly worried. He's already starting to call him Little Mikey, right? If you're a betting person, fun fact, the S&P 500 has actually correctly predicted the winner of the presidential election 87% of the time since 1928. So if you're into Intrade, take a look at what the S&P 500 is doing in the months of September and October, because if it's rising, there's a pretty strong chance that President Trump will be reelected. If not, all bets are off. There have only been 3 instances where that trend has been bucked. So where does that leave us? The current environment is clearly, if you sift through the noise and understand the political influence, what does the outlook look like? And I answer this question as I do every time it's asked of me. Take a look at what capital markets are telling you. The dirty secret, as I said last year, is the economics profession has a lousy track record of predicting the future economic environment, especially major downturns. And so the topic of my talk last year was a detailed walk through how you, as a C-suite executive, can understand the messages that the stock market, the bond market, the credit market, and the commodity market send you every day about the future. The stock market is obviously handicapping and looking out 18 months ahead as to what corporate profitability is likely to be. There has never been a recession in our country without a corporate profits recession. There has been a corporate profits recession without an economic recession, which means don't just rely on the stock market, but when the stock market starts to approach a bear market or a peak to trough drawdown of around 20% on a sustained basis, that's a pretty powerful message that the future economic environment might be slowing down. Secondly, the bond market, the slope of the yield curve. After we spoke about this in January last year, there was much media attention about the yield curve, the difference between short-term interest rates and long-term interest rates, and the signal that sends about future interest rate policy. There has never been a recession in our country for the last 50 years without the yield curve inverting first, 18 months prior to a downturn. So if the stock market is convulsing and the yield curve is starting to look flat so that long-term interest rates and short-term interest rates are about the same, that's a pretty powerful future indicator about a downturn. The third indicator, which helps to corroborate those two messages, is the message that credit markets send. So this is the ability of corporate America to finance itself outside of the banking channel by floating corporate bonds. And if you'll remember my talk a year ago, that premium on average tends to be around 5% or 500 basis points. And so if that credit spread starts to approach that level or poke through it, that is the corporate bond market saying defaults are likely to rise a year to 18 months out. Another powerful indicator that a downturn is on its way. And then the fourth indicator, which frankly does not get enough attention, because we are so used to here in the United States dominating global economic activity, is the health of the rest of the world. There has never been a global recession without the US going into recession first. And so in 2008, At the dawn of the great financial crisis, we still were producing the majority of global GDP. That is not the case today. And so the health of China, Brazil, Russia, and India, and the emerging world, as proxied by commodity markets, are incredibly important. This is why the market has erupted in a mini panic over the last few days. Because on the one hand, China has the ability to literally shut down its economy in order to avoid this pandemic from spreading. But what are the knock-on consequences for Chinese economic growth, especially as they are dealing with tariffs? And what are the knock-on consequences for global economic growth? So if you'd like to take a detailed look on that, and this is the subject of my longer talk when I do speak with Vistage groups about how to parse the messages that capital markets send every day, pick up a copy of A Recession Red Lights Flashing, or Are They? Available on the table outside. So the bottom line is, net, about the same as it was a year ago. If anything, with the stock market at all-time highs, the messages from the capital markets are, no recession is in sight. Acknowledge the fact that the economy has gone on for a long period of time. Acknowledge there may be late cycle dynamics at bay, but there is no recession in sight. There are two wild cards, I would argue, that need to be carefully thought through when looking at that toolkit. The first, self-evidently, is Federal Reserve policy. Another question you can ask Dennis this afternoon is, the Federal Reserve is loath to make changes in interest rates during an election year, lest it be seen to be partisan one way or the other. Everybody remember George H.W. Bush getting on Dr. Greenspan's back during an election year with a recession? Remember, he was taken out. So when everybody criticizes Donald Trump for trying to bully the Federal Reserve, remember, this is a game presidents have been playing for a long time. But they are loath to change interest rates. Chairman Powell explicitly said in December, we are not going to change interest rates in 2020. There will be a very high bar for us to change interest rates one way or the other. If we look at the outlook with inflation anemic, but risks like coronavirus, perhaps those odds are further cuts in interest rates. Tariffs, self-evidently, and we've prosecuted this issue in our Vistage group and the impact that this has had on small businesses. The reason why tariffs matter is not just that the Phase 1 deal eliminated $20 billion of additional tariffs that were going to go into effect in 2020. It's that tariffs create uncertainty. And take a look at this slide. I've traced it since the first quarter of 2016. I don't know how many of you all in the audience get the CEO Vistage Confidence Index. Some interesting data in there for you to parse. And obviously, I've denoted when President Trump was elected in November of 2016. First takeaway from this slide is, look how strong the consumer continues to be. We've all continued to spend. That's 2/3 of our economy, regardless of all the tweeting and political noise. But take a look at the effect that tariffs have had on Vistage CEO confidence. Vistage CEO confidence picked up sharply in late 2016 when President Trump started to enact his pro-growth deregulation policies, and actually peaked right about the time that they implemented the Tax Cuts and Jobs Act, which was, as I said earlier, explicitly designed to get you all off your seats to invest in future growth. In fact, halfway through 2018, capital expenditure had risen by more than 10% in both the services and manufacturing side of the economy. And then tariffs were implemented, and it hit a wall. And you can see how CEO confidence has declined and, of course, rebounded somewhat with a Phase 1 deal. So speaking of confidence, Patricia and I chuckled about this morning. If you dig a little bit deeper into the CEO Vistage confidence, how many of you all have been involved, are involved in Vistage groups, by show of hands? So I've got good news for you all, right? It's Lake Wobegon. We're all above average, right? Only 16% of us in December said the economy is likely to be better in 2020. Yet 57% of us think our profits are going to increase, right? 63%, nearly 2/3 of us, have plans to expand our workforce. So as Patricia said this morning, that's what Vistage is about. My business is fine. It's only your business that has an issue, right? So I want to call out 5 things for you to consider. If there's no recession in sight, but perhaps we are in a late cycle of steadily growing environment where the inflation may pick up. The first one that we've thought a lot about at Balentine is flexibility and simplification of decision making. How can you turn the next downturn into an opportunity rather than a situation where risk only has to be mitigated? Are you empowering your people to make decisions quickly under guardrails to capitalize on opportunities? Self-evidently an issue I'm sure many of you have grappled with, which is continuing to hire and retain employees in a very hot labor market. We're in the services industry. We have found that competing solely on price or wages leaves us behind the 8 ball, which is why we're so intentional about our culture and our behaviors and our flexibility. Pricing strategy. And by the way, a great resource here is Casey Brown, who I know does the Vistage circuit. I see Patricia nodding her head. But if inflation does start to pick up, how can you use that environment in order to raise prices to protect margins that are being eroded by having to pay your workers more money? She has a great saying price is only an issue in the absence of value add, right? Or as Richard Kopelman would say, the worst thing that I have ever heard is when a client tells me, I didn't know you did that, right? Cash flow management as the economy slows. I've seen very fast-growing companies die because they've been starved for cash. So think about lines of credit. Think about, especially if you're in a capital-intensive industry, if the economy were to slow down, how do you turn revenue into cash? And then lastly, consider that your runway for exit, if you are contemplating a transition event, may be shorter than you think. And it is a seller's market. I'm looking forward to what VRA and Reese have to say later on today, but I want to call out this particular dynamic. This is the WeWork valuation, right? WeWork Series A, April 09, debuted at 9 cents a share. First takeaway from this slide is it's been more than 11 years before WeWork went public. Private companies are staying private for a lot longer. Second takeaway is, guess who captured all the value? In Series G, price went to $47 a share, right? Not only are private companies staying private for longer, but it's the private equity guys that are capturing all the value. Of course, when it debuted last year, the public market said, you don't deserve that valuation, right? That's another anecdote. The way in which last year's class of IPOs have been treated by the public market is nowhere near the euphoria yet that normally characterizes major market tops. And so in closing, I'd like to take you on a journey, an important journey that I don't think people appreciate. This is a journey that's important for anybody who has started a business post-2009 who have never seen a recession. It's really important for people who've only been involved in the capital markets for the last 10 years. And this journey starts in 2000, when we convinced ourselves that trees could grow to the sky and Pets.com didn't have to make money to have an infinite multiple, right? And the technology bubble burst. And then the Federal Reserve responded to that by, guess what? Lowering interest rates, which eventually stoked the housing bubble and debt crisis. And guess what? The market halved again. And you can't see how dramatic these downturns are. You'll see it in a minute or two, because since then, the S&P 500 has been on a steady, smooth ascent. People have forgotten what it's like to have a 46% or a 52% correction in the stock market that are caused by recessions. The closest we came was the fourth quarter of last year, where we had what many would consider a major correction rather than a bear market. These are highly unusual times for capital markets. People ask us at Balentine every day, what in the world would I need to diversify my portfolio? You've only needed a driver and a putter to play the golf course, US stocks and bonds, right? Why in the world would I have to stay disciplined? And so the topic of our capital market forecast this year is the need to maintain investment discipline in highly unusual times. And I'll end off by saying this is just as important for you all if you're contemplating a transition event. What we have learned over 3 decades of helping to advise business owners and entrepreneurs is that a successful transition event is so much about psychology and process and discipline. And as I've alluded in both in the book with Robert, as well as an article out on the table, you'll only navigate that successfully if you stay in charge of your emotions, come to terms with the fact that you can only control so much in life after your business. It's a huge adjustment for many CEOs not to be able to come to work every day, set strategy, change tactics, hire, fire, and then to have to watch their nest egg go up and down as public markets react to every tweet. Think about your legacy. And that's really the focus of this book. We had an entrepreneur last week tell us, after my transition event, I felt like I was sent to the emotional hospice. Right? It's a serious point. And so in order to avoid, unfortunately, the shirt sleeves to shirt sleeves phenomenon that so often still occurs, where the first generation creates the wealth, the second generation husbands the wealth, and the third generation loses the wealth, it's just as important to be disciplined in how you approach a transition event in the same way as you might want to navigate capital markets. And so I would encourage all of you, if you're interested in receiving that book, to write your name down on a list. It is going to be published in the second quarter of this year. Finally, all of the articles that I referenced during my talk today are available on our website. There are a ton of resources available to any of you as you think about how to navigate capital markets and a transition event. Thank you very much for your time. I hope you have a chance to see what Dr. Rosling's message is for you. Thank you.